Good evening, everybody. It is still Thursday, May the 5th, but it's about 9:30 here in Toronto. Lots to talk about. Needed to cover the market, but needed some time to think about it. I'm your wealth guy. Let's talk money. Let's talk market wrap-up. So for everybody that's watching, I really appreciate you tuning in. If you like what I have to say, please feel free to subscribe, like, share, and comment. Be greatly appreciated. But let's talk about the markets today. So today, I think relatively unexpectedly, the market ended up pulling back essentially all of yesterday's wonderful gains. Now, what does that mean for the average portfolio? Well, it doesn't necessarily mean that your portfolio reversed to what yesterday's pre-market numbers were, but you definitely saw a loss. Now, overall, the risk in the market has increased. And we're at a point now where I think for many of you, comfort has to play a major factor in how you're going to look at your portfolio going forward. Essentially, we've breached very important lines with the S&P 500, taking a look at the Dow, even though I find that the S&P is far more important being a broader stroke of the market. The S&P did break the critical value of 4150, which is crucial to the downside. And breaching that, as long as we remain below this level, it could indicate further downside risk. Now, I'm not going to be quick to jump to say that that is necessarily the concern or that we are going to continue to fall further, but it's definitely something we do need to watch. If over the next few days we don't see an attempt to break that level back to the upside and be able to hold that, or if we see a rejection at the attempt, then that is probably a little bit of confirmation of more downside resistance or downside support. So we are going to see the markets potentially pull back further. Now, as a result, again, this is where risk tolerance becomes a major factor. Everybody wants to see the returns, but the risk now is where you really have to consider, because although you may want to make the returns, are you ready to take the downside with it? We've had a wonderful few years, I would say probably close to, well, at least 14 years of very strong upside for the most part, almost parabolic realistically, since basically the 2008 correction. And for the most part, many people haven't seen very many losses. Yes, we've had anomalies like March 2020, but that recovered in a relatively short period of time. So it's now time to give some of these gains back, at least a little bit. See, typical market cycles allow for that, but I think you still have to gauge your level of comfort. If you're finding yourself unable to sleep at night, then that's not a good sign. And maybe it might be time for you to take some money off the table here from risk on assets to risk off, or even sit in cash until the markets stabilize, I would say, for the lack of a better word. And then you buy back in, and that's okay. You've got to gauge your comfort. Now, looking forward, we have a few issues, and one of the major issues is economically, especially in the US. Canada here really not better, but we're going to focus on the US. We've seen some really bad economic news and economic numbers and data, especially this year throughout 2022. I mean, initial jobless claims this morning were absolutely abysmal, never mind productivity, which hit a 75-year low. Abysmal. Frightening, to be quite honest with you. Even though we're hearing a lot of the talking jaws or political figures and analysts talking about the markets and the economy being positive, the truth of the matter is it's really not. The economy has been cratering at an accelerated rate. And actually, I've been talking about this from as far back as August. But typically, the market has reacted very well to negative news, believe it or not. But it seems now the markets are finally starting to take note and reacting appropriately to negative market news, or negative economic news, I should say. Now, there is other buzzwords that have been used over the last couple of days, and recession tends to be one of them. The other one is hyperinflationary recession. Or even depression in some cases, I've heard. Now, neither one of these are essentially out of the realm of possibility, but the truth of the matter is, if you're not looking at it formally as far as government numbers are concerned, yes, we are not currently in a recession, but the truth of the matter is just look around. Look around. The job numbers are horrible. Inflation is out of control. There are more renters than buyers. It's a major concern. So are we currently in a recession? Very possibly. But still, the markets have always gone up. I think now, just to kind of go back and really think about it, you have, for myself, for my portfolio, my risk levels are very high. So I'm going to maintain my positions, continue to buy on the dips, and the markets will move as they move. But I think for yourself, if you find that your comfort levels have shifted, then it's very important that you're able to sleep at night, as I've mentioned, and this is the time for you to properly reassess your portfolio. And there's nothing wrong with taking your money out of the market or even partially remove yourself from the market so you don't miss if the markets do bounce back, and you don't want to be entirely out of the market necessarily. Now, that being said, how do I feel the markets are going to be moving forward? It's very hard to say. I think we have to keep an eye on that 10-year yield, which I always talk about. If the 10-year yield continues to spike, and we are over 3% now, I anticipate that the 10-year yield will be comfortable at 3% and slightly higher as we continue to see increases in interest by the Fed. But I'm really more concerned on the daily spikes. So today at one point we saw the 10-year yield spike over 6% to the upside. If we see multiple days of 2, 3, 4%, and I've talked about this, I say this almost weekly, that's where we're going to start watching and be concerned, because after all, the markets, the equity markets are the derivative of the debt market. So when the debt market starts to go, or you see an implosion in the debt market, that is the concern. That is the red flag. That is the immediate pull your money out of the market signal, because the markets will correct significantly. I wouldn't be surprised if we saw numbers of 60 to 80% to the downside. But for now, not playing that fear card, because the market was full of fear today as it traded. We saw everything sell off. NASDAQ is comfortably now, I believe, in a bear market. Whereas if we take a look at the US 30 or the S&P 500, both of those are in correction territory, but not at bear yet. So keep that in mind. Let's see what happens over the next few days. I think if we are unable to breach the critical numbers back to the upside, then we can anticipate that the markets could very likely continue to slip to the downside. But that's it, everybody, for tonight. Again, it's late. It's almost 10 o'clock here in Toronto. That's it, and I will see you at the opening bell.